Welcome everyone to this Markets Thursday. We are April the 29th. It's 8 p.m. here in London. So as usual, a quick disclaimer before starting. So those webinars are not investment advice. This is for information purely. So please do your own research before putting any position. I might have some positions on things that I'm mentioning today and might have not. But it's more education purpose than anything else. Quickly, my background started in 2000 as a cash equity trader, then moved to London in 2004, worked for 5 years, 4 or 5 years for a hedge fund, first on the long only product, then on the long short product. From 2009 to 2018, I was a prop trader for Infinity Capital Market here in London. Which is a subsidiary of First New York Securities. And I rejoined this company in January of this year. In 2014, I started to do some mentoring for another education company that I left in 2017. We started doing mentoring on my own in 2018 and launched in 2019 the 4x4 video series. So this is what I've been doing over the last 20 years. So I have 20 years experience in portfolio management, trading, short-term, mid-term, long-term, long only, long short. So a bit of everything with a focus mainly on stocks. So my background is a lot into stocks with Infinity. And since I've been trading for a hedge fund, I've been trading across asset classes, but really my skills are more into the into stocks. So what are we going to be covering today? So we're going to be, as usual, be doing the situation across asset classes. We're going to be briefly discussing the Fed meeting from yesterday, then looking at the earnings season, which so far how this earnings season has been unwinding. With the special case, XLE and energy ETF. And then we're going to be looking at the volatility with the fear index, the VIX. So I love the fear index. And we'll be looking more specifically at the rule of 60. So for those of you who have done the 4x4 video series, this is something I think that I mentioned in the video 5 or 6. Clearly, and briefly as an introduction, now the earnings season is in full motion with the Fed meeting yesterday. In terms of earnings, we had Microsoft, we had Apple, we had a lot of big names. So if you look at a day like today, for instance, in Europe and in US, it's probably one of the busiest day of the season. So you get tens and tens of companies coming with their earnings. So very busy day. We had the US GDP print, which came at 6.4% quarter on quarter. And the core PCE, so for those of you who have been following, the core PCE is at 2.3%. So there is inflation coming. This is no surprise. In terms of catalyst, now that the Fed is a bit behind us, to be perfectly honest, I didn't listen to the call yesterday. I was just, I found it a bit boring these days. Plus, there was a football game. So I didn't watch what Mr. Powell was saying. But there was not many changes. Just, my understanding is, it's more or less saying that the economy is improving and they will do something. And we're going to be looking at the calendar later for what they could be doing. In terms of catalyst, we still got the earnings season. We got the end of the month, so tomorrow. So even if the rebalancing has not been doing very well recently, what is interesting is to see that this month of April has been doing is classic seasonality. So that's something that I mentioned 2 webinars ago. So at the start of this month, saying, historically, April is a really strong month. In terms of seasonality, now we are going into weaker months. So that should be that. I mean, we should not be expecting the same kind of up month in the equity market, at least. And in terms of catalyst and drivers of the market, they are more or less the same. The market is still very much driven by options. So look at your calendar for the expiry of the S&P, the different stocks, and as well for the VIX. So let's discuss a bit the situation of the asset classes performances, looking at how the different So this is on the left hand side, we get stocks, so the equity, the indexes. So for the US, we are 10% more. For the S&P, we are up 11.4%, so that is as of yesterday. Russell, which is small and mid caps, are still outperforming the market. And you can see as well that across regions, markets are doing pretty fine. The only place in the world that is a bit struggling is China. Over the last week, we have seen actually even India performing quite nicely. In terms of year to date for the dollar, the dollar is trading sideways, up 1%, 2%, down 1 to 2%. So there has not been that many move. The Bitcoin, again, up 90%, there is a bit of retracement. And at the right-hand side, we get commodities with the gold and WTI. Gold, which is down 5 to 10% on the year, and WTI oil, which has been really strong. So the picture is not changing that much. We only get a rally across asset classes. So the situation is more or less the same. It's just if we compare from a couple of weeks ago, market is a bit higher. The S&P is up another 1% from where we were a couple of weeks ago. As I mentioned a couple of weeks ago, I thought that the market could come down based on the expiry. And after the expiry, we had quite a very small sell-off of 60 points from the high, so 1.5% roughly. And since then, we have been coming back up. So we look at the charts to see what has been the trend. Week to date, the picture again is the same. The last 5 days, it's a risk on market, and the currency for the dollar again is trading sideways, so not much happening. Interestingly, WTI is now trading around the 65. So the question is now is, are we going to be like many other commodities making new highs? So there is a strong push for commodities. That is something that we're going to be covering in one of the next slides. Year to date sector performances for those of you who are new to join on YouTube or tonight. The S&P 500 is made of 11 sectors. Okay, so what is interesting is always to understand what are the sectors that are performing or not performing. That gives you a lot of understanding of where you are in the economic cycle and where you are in terms of risk on, risk off. So energy has been extremely strong, financial based on something that we discussed in the past, of the steepening of the yield curve. But you can see as well that anything that is cyclical, industrial materials have been doing pretty well, 15%, and are outperforming the S&P, which is up 12%. The week to date, we're not going to be spending too much time because, again, this is the same as the WTI. Energy is going hand in hand. Other asset classes, if we start with the bond market, and that's something we're going to be covering a bit later. The question now is, are we going to see more inflation coming into the system? And if that's the case, there is a good chance that the sell-off, the bond sell-off that we had in Q1 will carry on. So if you look at the bond market over the last 4 weeks, there is a bit of digestion after a big move that we had in Q1, where the US 10 years, the US Treasuries moved by 70 bips, which is a lot, but that's not only in the US, across the bond market. The VIX the VIX, which is something again that we're going to be discussing in one of the few slides, which is the volatility of the overall market, is now around 17%, 16%. So way lower than when we started the year, and way lower than the average that normally you have on the S&P, which is at 19%. Top winners, top losers. As usual, during the earnings season, you're going to have big movers. And that means, if you have positions, especially in the US, this is really a market that is moving. Every earnings season, you're going to see big moves. So in terms of risk management, that is always something to be aware of. Quickly, in terms of, I would like to go into the price section. Honestly, we're not going to be spending too much time because I think the picture is more or less the same. I wanted to start with the S&P. The trend of the S&P is still the same. It's up and up with not that much volatility, as you can see with the VIX. So there has not been many changes. We are only making new highs. So the path is really the same. Probably tomorrow or the next few days we are talking 40 to 50. But it's a bit toppish. It's toppish in terms of the trend. For the Nasdaq, sorry, Nasdaq has been making new highs today. So there is the question is now, are we going to be doing this cup and handle and moving quickly higher? As we had some big tech companies. So today Facebook was pretty strong, but Apple actually has been struggling despite having beating the expectation. So it feels a bit like travel and arrive for Apple. Other markets, again, as the picture is more or less the same as the several webinars that we have done over the last few weeks. I don't want to be spending too much time on it. Currencies, we are trading sideways, and it's a range of 2 to 4%. So, and that is quite normal having those ranges. If you look at the ATR monthly, if you take any currency these days, normally we should be talking about an ATR monthly of 2 to 4%, and this is the trend that we have. So there is no real, color of, are we going to see a weakening of the dollar or strengthening of the dollar, based on, either this is the carry trade or this is too much printing from the US. The third part of the commodities, looking at here, all the commodities are making new highs. Okay, and that is an interesting picture because this is really the class asset that is moving the most. So yes, you can argue that equities and stock market are making new highs, but many commodities are moving quite big. So that's going to have implication in terms of inflation, for sure, because it's going to translate into the CPI and the PPI. And as well, it could translate in the future, 3, 6 months, 12 months, into margins, companies' operating margins. So if you have been listening to some companies' earnings call, Procter & Gamble and some others, actually there have been talks of how to deal with this inflation coming and how to pass these raw material increases to the consumer. So many companies have been saying, in the next 12 to 18 months, we're going to be increasing prices. And that tells you what? That tells you that inflation, which, 3 months ago, the Fed was saying, this is mainly due to supply chain disruption and, the world reopening. I think it's going to be, it's not that I think, but, there is a clear chance that we're going to have more inflation than just, for 3 months. And actually, this rampant inflation is going to be coming even more in the next 12 to 18 months. Even more so if you look at the different commodities, which are making new highs. If you look at the bond market, if you look at the US 10 years, and then we're going to be discussing about the other one up. So this is the 164 for the US 10 years again. So if you look at the last month, we have been trading between 150 and 170. So we have been digesting this massive move that we had since the elections and the vaccine, where we moved from 0.6% to 1.7. Now the question is, are we going to move another leg up in terms of yields, not in terms of bond prices? Let's go back into the presentation. Again, today, I want to make it quick and not repeating myself too much, because literally up, can I go there? Yeah, the picture is very similar to what we've been saying in the past. So let me check this card. Let me go there, and I'm gonna be reopening that. Okay, let's carry on with the Fed meeting from yesterday. So you know that I like this euro-dollar picture. Why? Because it tells us how the market participants consider the Fed will be moving in the foreseeable future. So the Fed has been keeping on saying, you know, we're not going to be doing much and we're going to be accommodative for at least 2023, 2024. If you compare the euro-dollar future as of yesterday from a couple of weeks ago, you can see that the 99 here and here, we are very much so like we were a couple of weeks ago. So there is no much change of Fed expectations, whereas the first quarter, you know, whatever the Fed was saying, the market didn't give a shit, and bonds were just selling off, and Fed expectations were coming sooner and sooner. The next move from the Fed, the 25 bips hike, is expected still, you know, around December 2022, which is, you know, in 18 months. And that is interesting because, you know, even yesterday, Powell was just saying, you know, we need to see more inflation coming. We are data dependent, blah, 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 blah. We know, again, that there is inflation coming everywhere in the system. So if you look at the calendar, the next big meeting from the Fed is in June. I think in June, they will start to talk about, you know, not many tapering, but, you know, that they start to have a conversation that is even more true. Why? Because we're going to have 2 months more of data and inflation. And there is a lot of talk now that the Fed will prepare the market from June onwards, and more importantly, probably around August when they meet, when there is always this pitch during the summer. And that means probably the tapering could happen from September. As long as we are in this blue sky scenario, meaning, you know, economy doing very well, earnings beating expectations, a lot of monetary stimulus and fiscal stimulus, because there are still talk that, you know, the Biden administration will do a fiscal stimulus. Clearly, this is a risk-on market. Risk-on market where all the risky asset classes are going up. So in terms of inflation expectations, if you remember correctly, when we looked at it a month ago, Fed expectations were, if you look at the US 10 years, so here this is what we call the US break-even 10 years, which is more or less what are the market participants forecasting of inflation in the future. So we used to be at 230 here, and there has been a small but still a bit of a move up on the expectations. So it feels to me a bit like the risk is on even more confirmation of inflation and another leg down in terms of bonds. So I will not be surprised to see bonds moving again. Actually, at the start of the session today, bonds started to sell off, and the Nasdaq and the tech came down a bit, not by much because we are back to square one, we are back to all-time high. But I think for the last months, it felt a bit like a truce between inflation expectation in the market, but there is a risk that now it might come back again, especially as if we eat the economy a bit too much. The Fed meeting here, this is the US 10 years that we discussed again. So this is 164 roughly. As you can see, that won't be surprising to see the US 10 years going up. And you need to look at the US 10 years, the Fed funds with the inflation, because it goes hand in hand. The target from the Fed is still 2% core PCE or CPI. And they said again last summer that they are keen on having higher inflation than usual. But as always, if the market pushes the Fed will have to react. The next slide is an interesting one, which is, inflation and risk on and appetite for risky assets. From the left-hand side to the bottom right, soybean, copper, corn, lumber, all those assets are making, all those commodities are making 2, 5, 10 years highs. Clearly, there is a huge demand. The world is reopening. There has been, as we've been saying, supply issues. But if we go from a commodity like soybean and a commodity like copper, that means inflation will come. As I've been saying 10 minutes ago, if you are looking at ID generation and how to do your ID generation, one of the biggest components that you should take into your analysis now is the impact of commodities in the operating margins. Because obviously the higher the cost of those commodities are in building your product, the bigger the impact could be. Again, you can see the trend. I've been putting only those 4 commodities. You can do all of them. It's up, 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 and that's gonna have repercussion for risk appetite, for inflation, for bonds, for operating margin, for sector allocation, industry allocation. What about the earnings season? So those slides are pretty, it's not the slides, but those charts are pretty good. So it's coming from factset.com. The beauty of factset.com, if you can put your name into their mailing list, it's pretty good. It's for free for retail traders or for anyone. That is pretty helpful. And so far, how has been the earnings season in Q1 2021? So as of Friday, so we have even more now, you had 25% of the S&P 500 companies that released their numbers. And we had 84% beat on EPS versus a 74% average. So 84% beat is just a huge beat. So that means if you look at history, and that's something that we have been doing and having for the last 3 to 4 quarters, companies keep on beating and are beating on a huge margin. So here, this is for the S&P earnings. And the next one is something that I'm put together, which is the source are the S&P. And I look at by how much the S&P 500 companies have been beating so far versus history. So in green here, this is for the last 3 quarters plus the Q1 2021. As you can see, if you put it into context that the 5 years average is at 74, you are way above. So that is why, there is a strong correlation by definition between the beat and how the earnings have been doing and how the equity market is doing. As long as the companies keep on having huge earnings and beating the earnings, that is the trend. The trend is up for the equity market. Here, this is the same with, instead of having, the earnings, this is for revenues. The revenues have been 77% beat for the S&P 500 companies, where on average you have 64% for the S&P. So again, huge beat go into insightfactset.com, put your name into their mailing list. That is helpful. If you're thinking, if you're trying to build your infrastructure, those are the things that I strongly advise to do. So earnings season, again, we are in the middle of the earnings season. What is important is always to know what's going to happen next. So I took the example of for tomorrow, so Friday the 30th, which is, as I said, the end of the month. And someone asked me to be more into bullet points into my presentation. Why you want to do that? Because you want to identify the companies where you could have an existing position. You want to see companies, when are the companies that you have on your watch list when they are coming with their earnings. You want to know when the big market movers are talking to the market. So we started with JP Morgan. Today, we had Apple, we had Microsoft a couple of days ago. So those are the market movers. Those are the sector leaders. So those are the companies that have been doing pretty well so far and have been outperforming the market, the FANG of this world and the QQQ and the tech companies. So as long as those leaders are beating the expectations and doing fine, that's going to tell you a lot about risk on and the perception and how you should be positioning your portfolio. And as well, that tells you a lot about sector leaders, industry leaders. So that means if you have a position, you always want to know how the best in the industry or the sector has been doing. And there's another point here which I put, which is the conference call time. Each time you go into the earnings, there is a conference call. What is really important when you have a position or when you're thinking about putting a position is knowing when is the company on the day coming with talking to the market. Why? Because it's going to be making and moving the market. So if that's before the open or after the close, that is fine. But if you have a call during the session, that's going to impact, and that could impact the way the stock is going to move. And so here we get the example tomorrow with some European banks. So there is, for instance, BNP that is coming. But in terms of US market, I think what is interesting is tomorrow we get ExxonMobil and we get Chevron. So you get the big oil majors in the US that are coming tomorrow. And if we go into the next slide, why I want to look at those two names, because if you look at the XLE, which is the ETF for the S&P 500 energy, as we've seen before, has been outperforming the market and up, something like 40%, like a WTI. But as always, when we look at an ETF, we need to know what is making this ETF. What is making this ETF is mostly Exxon and Chevron, which are making roughly 45% of this ETF. So you know that tomorrow, almost half the companies that are making the ETF, the XLE, are going to be coming with their earnings. So that's a big day tomorrow for the XLE ETF. And always you want to know, out of these 11 sectors, what are the biggest companies, when are the biggest companies, and when they could impact those sectors. Now, I want to, for each webinar now, I want to be a bit something more education, even if the other ones are education. I want to talk about the rule of 16 of the VIX. So as I mentioned before, this is something that I talk in the 4x4 video series. So the VIX, or the volatility index of the S&P, is dispatched real time by the Chicago Board Options Exchange, or the CBOE. And for the marketing, it's known as the fear index. The way you calculate the VIX is you're going to be taking different tranches of options between 23 days and 37 days here for the S&P expiration. And that's going to give you a level of implied volatility for the next 30 days. the definition of the VIX, it represents one standard deviation of the market's estimation of the changes in the price of the S&P during the next 30 days. So if you go more into details, because these days you have many retail traders that are playing with options, and when I say playing, they are not investing, they are literally playing. Most pricing are coming from the Black-Scholes models that I explained as well in the 4x4 video series. But what is important is, as an investor, as a trader, if you look at the implied volatility, that is a better way to understand the risk in your portfolio and if you could have some opportunities as a trader. If you look at the Black-Scholes models, those are tricky model, quite complex model. In reality, very few traders understand how to calculate in depth those volatility and those Black-Scholes models. I remember 20 years ago, I was doing an internship and I was in a trading room in Paris, and I was talking to one of the consultants there, and he was telling me, you know, very few traders understand how to do it. This is why you get prices for the Black-Scholes models. If you want to find some prices, there will be tons of them on internet and how to price those things. Here we are still looking at the rule of 16, where to get the daily implied volatility, we want to divide the annual volatility by the square root of the number of trading days per year. So if we take a normal year, you're going to have roughly 252 days, trading days, working days. So if you do the square root of 252, that gives you roughly 1587. So to give you an example, if you take a 20% annual implied volatility, that will translate into 1.26 daily implied volatility. Okay, so that's here we should be talking 20 instead of 30. That's better, and that gives you a 1.26%. So what about the rule of 16? The rule of 16 is very helpful and easy to remember. Why? Because that gives you the change. If the VIX is at 16%, that tells you that 68.2%, which is one standard deviation, the S&P is going to be moving by 1%. So think about, you know, you look at the VIX, you know that the average is at 90%. You know that over time it went from, let's say, 9% to 80%. If you are 60% and you think that the S&P returns are going to be doing like this, you're going to have at 16% one standard deviation of 68% chance that the S&P is going to be moving by 1%. Okay, so I think this rule of 16 is pretty simple. Think about 16% VIX is 1% move on the S&P. So if we look at the past, how the S&P, or should I say the VIX, the implied volatility of the S&P has been doing over time, and looking at the VIX closing above 16 for each and single year. So the VIX started in 1992, so that's, I mean, depends, sometimes they give you other numbers, but if you look at those numbers, you can see that we are going through cycle of higher volatility. So that's going to be here, the dot-com bubble. For 3 to 4 years, the market is very quiet. So you got a cycle of lower volatility, economy doing fine. And you got another cycle of high volatility, which where you have 3 to 5 years of high volatility, where the VIX is going to be more than 90% of the time above 16%. And what is interesting here is, as you can see, we had a very long time of low volatility from 2012 to 2020, where actually the VIX was very low in 2016 and 2017, but you can argue as well that 2013 and 2014, the market experienced low volatility. And that's, again, that goes hand in hand with the economic situation. So there is no surprise. Year to date, the VIX has been trading above 16% every single day, even if it's coming down. Again, as this is something that I keep, this is something that I always watch. We'll do another video between implied volatility and realized volatility. But keep in mind this rule of 16 for the VIX, which again is the S&P moving by 1% on the day. Now let's quickly discuss what I can offer if you want some help. So this is the education. I'm still building the trading community. So I just recently changed the format. I want as much as possible people to participate and bring ideas. It takes time. It's like trading. It's not going to happen overnight. I get very good mentees, so I'm pretty sure that we're going to have something interesting. So I'm pretty excited about this product. Another product, which is the 4x4 video series. So that's an online video course that I built in 2019, based on my experience as a trader, as a portfolio manager, as an educator, where you're going to have access to 40 plus videos, 30 hours of footage, 50 Excel spreadsheets. And really what is key here is to build your portfolio based on 4 filters: top-down, bottom-up, special situation, and active trading. My conviction is if you want to be successful, you need to be quite flexible. So this is why I call it the 4x4. And where you want to be both a portfolio manager or a trader, depending on opportunities. Next level to the education is the mentoring program. So this is one-on-one session on Skype. This is about how we are going to be together dealing with your own money, building your portfolio. And that's the same process as the 4x4, keeping in mind that, there are different steps. The first step is about helping you building your infrastructure, which is key, looking at quantitative analysis. Then we look at qualitative analysis. Then we look at price action, risk management. We do some options. It's not going to be 100% options. Don't get me wrong. Don't get fooled by other educators that are giving you silly and stupid returns. I think this is pretty sad, and this is pretty concerning that everyone, I have many people coming to me and say, "Oh, Greg, can I be making 500, 1,000%?" This is it's just a big lie. So be careful. I don't know why those people are going. I know why, but I think this is very tricky. 2 things. It's 4x4 mentoring program. This is either if you want to have access to the industry or if you want to be managing your own money. Quick question. So as I said, I wanted today to have a shorter webinar, because I think, the situation is the same as a couple of weeks ago. Nothing has really changed, just the assets are going higher. And maybe in the near future, we're going to have some changes, but the positioning is more or less the same. Any question, anyone? No. Let me check into the Q&A session. So question, does inflation and commodities and prices and companies saying they will pass their price increase into customers in the next 12 to 18 months good for the companies? It is good for the companies as long as they can pass this increase in raw materials to the consumer. But there is always a limit. The question is, that is something that we look at in video series between 20 and 25, is when you look at the fundamental analysis, you need to be thinking about, is the company price taker or price maker? If they are price maker, they don't care. They can give you the prices they want. If they are in a monopoly or if the market is going like crazy. If they are price taker, or if they don't have the same leverage, then that becomes an issue. And there is always a limit. So I think what is interesting from the difference from 10 years ago is with this fiscal stimulus, you get real inflation coming into the system. If you look at 2012, 2013, 2014. What created social unrest around the world, and especially in the Middle East countries, where when we had the prices of commodities going higher. So if you look at places like Egypt, like that was Tunisia, some places, really people were struggling with the prices of commodities going up. So you can assume that if we carry on with those commodities going higher, some places in the world, like potentially emerging markets, which are importing a lot of those commodities, the wheat, even China. China is you know, I read this week that they were switching from corn to wheat or whatever because the prices were going too high. They are importing tons of commodities, pork, wheat, soybean, and that has implication for the powering power of individuals. Samir, what is your outlook on China with the tightening and the credit issues we saw lately? Yes, the yuan bonds. So yuan bonds, this is a good point, Samir. So China, I think for H2 it will be slowing even more. So if you look at Q1 numbers were not great. That was actually one of the worst quarter. The Chinese Politburo is still putting a lot of credit into the system, but there is slowdown. And as I just said, the rise of commodities will impact internal consumption because they are very heavily dependent on importing. The issue on top of, you have several issues with China, which is the world has been cooperating now to say that is a bit too much, which started with the Trump administration. So Trump administration get a lot of hit of going after China, but actually that was not such a bad thing in the sense that the world had to position and not selling all these assets, its assets. So there is slowdown, there is struggle with the rest of the world because the world is restarting. So and you have opacity. So as an investor, what I always say, and I'm sorry to say that, you need to apply a discount in your investment process when you look at Chinese ideas or Chinese investment, because you can't rely on numbers the way you rely on numbers coming from the US and from Europe. So it's pretty hard to have a very good picture of what is happening. What are your views on video on their trader making 800%? I have no view. I find that pretty sad that you know, educators who said first, you know, you need to have realistic expectations are now selling 800% returns. And I think it's pretty sad because if you take your universe of many traders, you can always pick the guy that is making this return. What I find sad is the positioning to say, oh, you're going to have to do options and let's do option guys. I know why they say you need to do option guys because it sells. But, you know, this is just, I'm pretty happy because I know that in 12 to 24 months, you know, most people will come to me and say, look, Greg, I've been struggling and I know it was a fake and you said it. But I think it's very misleading if you go into the camp of selling 800%, but look, this is the way it is, and you know that is pretty sad if people are going for those stories. What it is creating is I have many people coming to me and say, you know, I used to be very cautious in my investment process, and I see this guy in crypto. I see those people, you know, saying that we can be making 500%. Greg, I want to be making money quick. And that means this is the fear of missing out. And despite the market being on all-time high, and we know that many parts of the market are very frothy, because of these behaviors, it creates frustration, and retail traders go for things that they don't understand or things where they don't have the good risk management. So I find that pretty sad, and that is very confusing for retail traders. what kind of blueprint the catalyst could give the reader to help the timing the position? So that's a question from Ali. Ali, when you look at putting a position, you always think, okay, that is an idea, that is not necessarily a position yet. And you need to think about in terms of catalyst. If that's just to be playing the market, don't spend time of looking at 200 IDs, you just play the S&P. But if you are looking at a single ID, and that can be an ETF, sector, industry, or a single name, you get a catalyst. Most of the time, you're gonna have a timing for the catalyst. That is why you can be using sometimes options, and that is why sometimes you can't be using options, because you know that there is a catalyst, but you don't have the timing. Okay, so if you are in an environment where the implied volatility is pretty high, if you only do options, and this is why I'm pretty pissed, if educators are telling us, you know, oh, do options, do options, do options, you know, if nothing happens, you're gonna piece away, you know, out of your 5-10 positions that you have, and nothing happens, you're gonna piece away, you know, 10 times your premium. So that means you're gonna have 10 stop losses. And so that means if I go back about the catalyst, I'm always trying to say, okay, what's going to happen? If I look at the earnings is a natural catalyst, but in the meantime, this is a very binary outcome. Okay, so it's the casino. So this is why we try as much as possible to find either how the sector is doing, how the industry is doing, and how the single name is doing. By definition, for me as an educator, it's very easy to say, but much harder to do. And this is where the frustration is building, because in a market that is going up, you know, that people believe that they are smart. They believe that they are smart to make 200, 500, 1,000%, but they are not smart. They are just long the market, and this is it. So when market changes, you know, call me back in 12, 18 months back. 12, 18 months in the future, please feel free to watch the webinars. But I think, you know, it's everything that is going these days, or most that is going these days. And you can't be blaming on one hand people that are doing crypto, and on the other hand say, look, guys, you're going to be making 500% with me. That is just shocking, but that is just me, and probably I'm a boring person, but this is what it is. I think this is it for today. That was a bit shorter than usual, but again, the market's conditions are more or less the same. We are still going up. I watch only one thing more or less with the S&P, which is this trend that started in October, November. So for today, we will be, or for tomorrow, we'll be at 42.50. I look at options, I look at when they are expiring, I will be looking at single names. And now we have probably a good thing in terms of risk appetite, which is the S&P and the sector which were lagging, making new highs. As always, I hope it helps. If you have questions, if you got ideas, if you want to be discussing things during those webinars, please feel free to share with me, and I hope it helps. So see you in a couple of weeks, and enjoy this market. Bye-bye.